Welcome to Breaking News to Trading Moves.
We are tackling a pretty massive paradox in market structure today.
Yeah, we really are. Think back to 2010. The flash crash wiped out nearly $1 trillion in market value in just a matter of minutes.
Oh, right. Blue chip stocks were plummeting to pennies before rebounding just as violently.
Exactly. And one of the prime culprits driving that sheer, uncontrollable velocity was a tool originally designed to prevent losses.
The stop-loss order?
Right, the stop loss. So today, we are debating a core question. Are physical stop-loss orders an essential risk management tool that protects traders, or do they act as a structural vulnerability that exposes participants to targeted institutional manipulation and artificial market volatility?
It is a critical question for anyone participating in modern financial markets. And, our debate today draws entirely from quantitative market analyses, agent-based financial simulations, and institutional trading guides.
We are essentially asking if the shield you carry into battle is actually painting a target on your back. To be clear on where we stand, I argue that stop losses are an indispensable defense mechanism against catastrophic loss, and that vulnerabilities only arise from predictable amateur placement.
And I argue that hard stop losses create visible liquidity pools that institutions actively exploit, worsening market volatility, and that true risk management lies in strict position sizing.
I see why you think that, but let me give you a different perspective on the mechanical realities of participating in a live market. A physical stop-loss order provides an absolute mechanical barrier against catastrophic drawdowns.
Sure. In theory.
Not just in theory, in reality. We operate in an environment where the unexpected is the norm. A trader could be completely correct in their macro analysis, but still face a sudden, extreme event.
Like a sudden headline hitting the wire out of nowhere?
Exactly. A localized internet failure, a technology outage at your broker, or a geopolitical headline that causes an immediate market gap. In those exact moments, if your protective order is not physically parked on the broker server or sitting directly at the exchange, you are entirely exposed.
Right. You're left holding the bag.
Yeah. You are relying on your own ability to manually click a button when your screen might be completely frozen, or the market might just be moving way faster than human reaction time.
I come at it from a different way. Entering a hard stop loss into an order book inherently compromises a trader's position by turning their risk management into another participant's liquidity.
How so?
Well, the moment you place that physical order, you are no longer just managing your own downside. You are altering the structure of the market itself.
By adding a limit order?
By placing your cards face up on the table for everyone with level 2 data to see.
But, that is just transparency. How does that directly harm the individual trader?
Because those orders do not just passively sit there. They are combustible fuel. When a market drops and hits a cluster of stop-loss orders, those stops instantly convert into market orders.
Right. Forcing an immediate sale.
Exactly. That forces immediate selling, which drives the price down further. It creates this vacuum of liquidity that pulls the price even lower and triggers even more stops. You aren't just protecting yourself, you are participating in a structural chain reaction.
Let's actually pop the hood on that for a second. If we look at the mechanics, you're talking about how these orders interact with market depth.
Yes, we need to look closely at the mechanics of a liquidity grab. Imagine an institution moving $1 billion in a mid-cap stock.
Right. They can't just click buy at the market price.
No, they absolutely can't.
Because the order book might only have a few thousand shares offered at the current asking price.
If they execute a standard market order for a massive position, they would eat through the entire order book and suffer massive slippage.
Precisely.
The sheer size of their order will consume all the available sell orders at the current price, then the next price up, and the next price up.
They will end up paying a terrible average price for their asset.
Exactly. So to enter or exit these massive positions efficiently, they require a tremendous amount of localized liquidity. And where do you think they find it? Right where retail traders park their stop losses.
You mean at obvious technical levels?
Yes. Retail traders overwhelmingly place their stops at predictable locations, like round numbers are a classic example.
Right, the psychology of a clean number.
Yeah, if a stock is hovering around $102, there's a giant cluster of sell stops sitting exactly at $100.
Or traders place them right below recent swing lows on a chart.
So the institution pushes the market into that zone. Exactly. They intentionally drive the price down into that specific zone to trigger a massive cascade of retail stop-loss orders. And remember, a stop-loss on a long position becomes a market sell order.
Causing a flood of sells.
A total flood. And this provides the exact liquidity the institution needs to execute their massive buy order without suffering slippage. They absorb all that panic selling, accumulate their position at a great price, and then the market naturally reverses right back upward.
Okay, wait. If institutions are simply utilizing available liquidity to execute large orders, isn't that just a natural function of market depth rather than malicious manipulation?
Natural function?
Yes, the market is designed to match buyers and sellers. The institution sees a pocket of liquidity and accesses it to fill a large block of efficiency.
It is a function of market depth, yes, but it preys on a structural vulnerability that traders voluntarily provide by, broadcasting their exit parameters.
But that vulnerability is entirely self-inflicted by traders who rely on simplistic chart patterns. A poorly placed stop-loss isn't a seatbelt, it's a tripwire.
A tripwire, you are telling them to install.
No, I am saying if you place it right below a round number, you're tying a string across a highly trafficked doorway. The solution is not to abandon the stop-loss entirely, but to adapt your placement methodology to account for this structural reality.
How so? By just hiding it further down the order book?
By using volatility-based placement. Instead of placing a protective order exactly one tick below a widely visible swing low, a trader must use a metric like the average true range, or ATR.
To measure historical movement.
Exactly. ATR measures the actual historical movement of the asset over a specific time frame. Let's say a stock is trading at $100 and it moves an average of $2 a day.
So $2 is your average true range.
Right. If you buy the stock at 100, placing your stop at 99 is practically begging to be triggered by normal daily noise.
Because you are placing it within the asset's normal operational variance.
Exactly. But by setting a stop at 1.5 to 2 times the average true range away from your entry, say down at $96, you are placing your order well outside the normal expected fluctuations of the asset.
I see.
You stay completely out of those predictable danger zones that institutions might target, while still maintaining that vital, hard-coded mechanical protection against a true structural breakdown.
Okay, using ATR to widen your stop makes sense on an individual level. It keeps your specific order out of the immediate danger zone. But let's zoom out from the individual trader and look at the whole ecosystem.
You mean the macro effect?
Yeah. Even if you hide your stop, the fact that millions of others do not changes the actual physics of the market. When we introduce these automated triggers into a living market, we change how price moves.
Right. The systemic consequences of these orders existing in the aggregate.
Exactly. The agent-based market simulation from the Cypress study illustrates this perfectly. They utilized historical limit order book data and populated the environment with simulated agents to observe the pure mechanics of price action.
And what did they find?
The findings are stark. Introducing stop-loss orders into a market increases mean volatility by 27%.
Wow. A 27% increase in volatility just by having the orders present in the system.
Yes, but the most alarming finding was the asymmetry of the shocks. When a downward shock was introduced in a market populated with stop-losses, it caused a price deviation of $3,000.
$3,000?
Compare that to an upward shock, which only caused a $1,000 deviation.
Okay, let's break down why that asymmetry exists. Why would a downward shock be 3 times more destructive?
Because markets possess an inherent long bias. The vast majority of participants are buying assets, hoping they go up, which means they place sell stops below the current price to protect themselves.
Right, there are far fewer buy stops placed above the market by short sellers.
Exactly. So when a downward shock hits, it encounters a dense minefield of sell stops. Let's map out that chain reaction. A piece of bad news hits, the market drops $10.
And hits that first layer of stops.
Yes, it hits that first dense layer of sell stops.
Those stops instantly convert into market sell orders. Because they are market orders, they accept whatever price is currently available.
Which consumes all the buy orders.
This aggressive selling consumes the remaining buy orders, pushing the price down another $10. That hits the second layer of stops.
So the chain reaction just fuels itself.
Completely. The market falls, hits a layer of stops which generate market sell orders, pushing the price into the next layer of stops. It creates artificial, self-reinforcing price cascades.
The combustible fuel you mentioned earlier.
Exactly. The stops act as combustible fuel that ignites, creating a vacuum of liquidity that pulls the price down $3,000. An upward shock simply doesn't have that same fuel because people aren't aggressively protecting profits the way they panic to protect against losses.
Okay, I'll give you the simulation data. The math holds up in a vacuum. But we have to operate in reality, and I must challenge the alternative. Without a physical stop in the order book, how does a trader survive the very real slippage caused by low liquidity during economic releases?
That's a compelling argument, but have you considered that by placing the hard stop, you are mathematically guaranteeing execution during that precise moment of lowest liquidity?
Guaranteeing execution is exactly what a stop loss is designed to do. It gets you out, but let me finish my point about economic releases. Like payroll data or inflation reports.
Sure, major news events.
During those announcements, like non-farm payrolls or a surprise interest rate decision, the order book essentially empties out. The high-frequency algorithms and liquidity providers just pull their limit orders to avoid the extreme volatility.
They step completely aside.
They do. The market becomes incredibly thin. If bad news hits, the price can gap down violently. And let's look at the mechanics of the exchange itself during these moments. Exchanges like the CME employ a mechanism called velocity logic.
Where it detects anomalous speed?
Yes. If the market drops too many ticks within a specific, tiny time window, the matching engine essentially pulls the emergency brake. It halts or pauses trading to let the order book repopulate.
Right.
And that pause practically guarantees massive slippage upon the reopen. If you are sitting there without a physical stop loss, relying purely on your intention to sell if things go wrong, you are trapped.
Trapped by the halt.
Yes. If you are relying on a manual mental stop during that halt, you will be utterly destroyed by that gap. Your manual execution will be filled dollars away from your intended exit when the market finally reopens.
But a physical stop suffers slippage too.
It does. But even if it suffers some slippage during a cascade, it acts as a definitive line in the sand. It triggers the moment the price is touched, getting you in the queue. It is the lesser of two evils compared to holding an unprotected position in an illiquid gap.
Again, it gets you out blindly into the void of the order book. When that emergency brake is pulled, or when the cascade is at its peak velocity, liquidity is at its absolute lowest.
But you are out.
You're out, but your physical order executes at whatever abysmal price is available in that fraction of a second. Given the systemic vulnerabilities we've discussed, from targeted liquidity grabs to automated price cascades, we must explore how traders should actually defend their capital without relying on a tool that works against them in the worst moments.
Okay, walk me through the mechanics of that alternative. If I am not putting a physical barrier in the market, how am I structurally protecting my account from a catastrophic event?
It comes down to basic capital preservation math and strict, uncompromising position sizing.
Position sizing over a stop loss.
Yes. The mathematical reality is that position sizing is vastly superior to the reliance on stop losses. Let's say you have a $100,000 account.
Okay.
If a trader rigorously sizes their position so that they are risking exactly 1% of their total account capital per trade, meaning the absolute maximum loss on that trade is $1,000, a total failure of that specific position remains entirely manageable.
You mean sizing the trade so small that even if it goes all the way to zero, you only lose 1% of your portfolio.
Exactly. You neutralize the threat of the cascade or the gap because the absolute maximum loss is structurally contained by the sheer size of the trade itself.
So you don't even need to stop.
You don't need a stop loss to save your account if the position size is too small to ruin it. The math of recovery is brutal and unforgiving. A 10% drawdown requires an 11% return just to break even.
But a 50% drawdown requires a 100% return to recover.
Exactly. Prevention of large drawdowns through strict sizing is paramount. If your position size is small enough, you can employ what we call mental stops.
Where you just keep the exit number in your head.
In your head or, on a local alert system that chimes on your computer but doesn't send data to the exchange, you maintain your exit criteria locally.
Keeping it off the books.
Yes, you hide your intent from the order book entirely. By doing this, you become essentially an invisibility cloak. You're invisible to the institutions looking for liquidity.
And you retain optionality.
Precisely. You retain the optionality to manually close the trade when market conditions stabilize, rather than being algorithmically forced out at the absolute worst possible price during a temporary spike.
I'm not convinced by that line of reasoning because it completely ignores the realities of human psychology. Mathematical position sizing is crucial, absolutely. But relying on a mental stop to execute that mathematical limit is a proven vulnerability.
It takes discipline, sure.
It takes more than discipline. The trading psychology data is unequivocal on this. Mental stops require absolute machine-like discipline, which the vast majority of human beings simply lack when their own money is evaporating.
Humans can be trained to execute a plan. It is a learnable skill.
They can, but in the heat of a fast-moving market, cognitive biases take over. Let's put this into context. Think about the last time a trade really went against you. You bought a stock at $60 and you set a mental stop at $50.
Okay.
You tell yourself, if it hits 50, I am out. No questions asked. The market drops. It hits $49.90. What does your brain do in that exact moment?
Well, you start looking for reasons to hold.
Exactly. Your brain immediately lies to you to protect you from the pain of realizing a loss. There is immediate anger and denial. You tell yourself, oh, this is just a liquidity grab. The institutions are just testing the lows to shake out the weak hands. I will wait for the bounce back up.
You hesitate.
You hesitate. That hesitation turns a small, planned exit into a slightly larger loss. Then the bargaining phase begins. The price hits $48. You widen your mental parameter.
You tell yourself you will sell as soon as it bounces back to 49.
Just to minimize the damage, but the market drops to 45. Suddenly, you are an involuntary long-term investor holding a deteriorating asset.
That is a failure of discipline, not a failure of the method.
But it is a predictable failure of human nature. By the time the pain becomes unbearable and you finally click the sell button, you have taken a loss far greater than your original 1% parameter.
I hear you.
A physical stop fires when you are at your weakest emotionally. A mental stop requires you to be at your strongest, exactly when your brain is flooded with cortisol.
Right.
Human nature leads to hesitation, and in markets, hesitation is penalized severely. Therefore, proper position sizing must complement physical stops, not replace them. The position size dictates the risk, but the physical stop enforces it. You cannot trust a human brain under stress to execute a flawless risk management protocol when real capital is evaporating in real time.
You are highlighting a very real behavioral flaw, but you are trying to solve it with a structural tool that actively works against the trader.
How is enforcing my risk working against me?
Yes, human discipline is fragile, but outsourcing that discipline to an order book where algorithmic predators are mathematically programmed to hunt for those exact orders, that is a cure that is worse than the disease.
You view the order book as purely predatory.
I view it as a competitive arena where transparency of your pain threshold is a massive disadvantage. A trader must develop the psychological fortitude to execute a mental stop, precisely because hiding that order is the only way to retain control of the execution price.
By retaining manual control.
Yes, when you use a physical stop, you are surrendering control to the market's matching engine at the exact moment the market is behaving most irrationally.
I argue you are retaining control by defining your absolute worst-case scenario ahead of time before the emotion clouds your judgment.
And I maintain that defining the worst-case scenario in a database visible to your counterparty guarantees that the worst-case scenario will be realized more frequently than statistical variance would otherwise dictate. The market is an adversarial environment. In any adversarial environment, broadcasting your breaking point is a tactical error.
Well, let's summarize our distinct perspectives based on the mechanics we have explored today. I maintain that physical stops, when utilized correctly, remain the ultimate safeguard against severe market movements.
Provided they are placed correctly.
Right. The critical caveat is that they must be placed strategically, using dynamic volatility metrics like the average true range rather than static, obvious technical lines, keeps you out of the danger zones. When properly calibrated, the physical stop provides a necessary emotionless circuit breaker against technology failures, unforeseen market gaps, and the inevitable breakdown of human discipline during periods of acute financial stress.
And my position remains that hard stops act as visible targets for sophisticated institutional algorithms. The simulation data clearly shows that injecting these automated triggers into an order book structurally increases overall volatility.
The combustible fuel.
Price cascades that harm participants. By relying on strict position sizing, capping risk mathematically at the portfolio level, coupled with mental execution, a trader offers a much more secure defense. This approach keeps their intentions hidden from the market and allows for execution discretion during moments of extreme temporary illiquidity.
Despite our different mechanical approaches to the solution, we clearly converge on one absolute truth presented in the material today.
Oh, definitely.
Placing protective orders at predictable round numbers or immediate swing lows is a fatal flaw. Whether you view the market as maliciously hunting those orders or simply efficiently seeking liquidity, placing a stop exactly where the rest of the crowd places theirs guarantees exploitation.
We absolutely agree on that point. A simplistic approach to risk management, one that does not account for the actions of larger market participants, will fail. The value here lies in understanding market structure from an institutional perspective. Recognizing how order books function, how liquidity is sourced, and how price moves structurally allows an individual to stop trading in the dark.
It encourages listeners to evaluate their own risk parameters within the context of the quantitative realities we discussed today. There's always more to explore regarding how markets balance efficiency with volatility.
Returning to the concept of the brightly colored home security sign on the front lawn we alluded to, the goal is not to abandon security altogether, but to realize that true protection often requires a more sophisticated, less visible approach. If your defense mechanism is entirely predictable, it ceases to be a defense and simply becomes a highly detailed map for anyone looking to break in.
Thank you for joining us on Breaking News to Trading Moves.